Hello and welcome to the lecture on accounting and financial reporting for leases, which is a part of the Advanced Topics in Governmental Accounting course at the Rutgers Business School. The purpose of this lecture is to begin by talking about the ways that leases are accounted for at present, to talk about primarily the GASB's proposed changes to those standards, and hopefully in the course of discussing those proposed changes to understand why the GASB believes those changes are necessary and how they will improve accounting and financial reporting for leases. So beginning with the current approach to accounting for leases, that is all embodied in Section L20 leases of the GASB's codification, which comes from GASB Statement 62, which gathered together all of the existing lease standards that GASB was depending upon that were issued by the Financial Accounting Standards Board, or FASB, primarily FASB Statement 13, at least as those standards had been amended through November 30th, 1989, which is the cutoff point in terms of the applicability of previously issued FASB standards to state and local governments. They are required, or were required prior to the issuance of GASB Statement 62, to apply all FASB standards as they were as of November 30th, 1989, as long as they didn't conflict with or contradict GASB standards. The point of GASB Statement 62 was to make it easier for governments to apply those standards by bringing them all into the GASB's own literature. Some of the GASB's accounting for leases is also based on Statement 5 of its predecessor, the National Council on Governmental Accounting, or NCGA. The big feature of the existing lease standards, as you know, is the differentiation of the treatment between capital leases and operating leases. And there are four criteria that are established in the standards, and if a lease meets any of those criteria, it is considered a capital lease for accounting and financial reporting purposes. If the lease transfers ownership of the property to the lessee by the end of the term of the lease, it is a capital lease. If it contains an option to purchase the leased property at a bargain price, it would be a capital lease. And here are the two that I think are probably the most operable. If the lease term is equal to or greater than 75% of the estimated economic life of the leased property, or if the present value of the rental or other minimum lease payments equal or exceed 90% of the fair value of the leased property, then the lease is considered a capital lease. And all other leases, those that don't meet any of those four criteria, are considered operating leases. Now, there are important implications to that differentiation between a capital lease and an operating lease. An operating lease is essentially accounted for as a period inflow and outflow transaction. Payments go out or payments go in, depending upon whether you're the lessee or lessor, respectively. But there's no impact on statements of financial position, like a balance sheet or the statement of net position. A capital lease, on the other hand, results in the recognition of a capital asset, a capital lease asset, and a long-term liability related to the requirement to make payments in the future to the lessor. In the governmental funds, a capital lease is accounted for exactly the same way you would account for the issuance of long-term debt to obtain a capital asset. You don't report the long-term debt or the capital asset, or in this case the leased capital asset, or the capital lease payable. You instead report the proceeds as another financing source and you report an expenditure. So let's take a look at an example of how a capital lease would be accounted for under the existing standards. So look at an example of a government with a 10-year lease that meets the criteria for a capital lease. So we're treating this as a capital lease. And the lease requires annual payments of $100,000 a year every year on July 1, beginning on July 1, 2015. And the equipment is delivered to the government on that date, on July 1, 2015. Let's presume that the rate that's being charged here is 10%, which is maybe a little high, but it's just easier to deal with in the example. So we use that as the discount rate, and we calculate the present value of the 9 future payments of $100,000 each. So the cash payment on July 1, 2016 and forward, that present value is $575,902, and you add to that the initial cash payment in the current year of $100,000. So the total present value of the capital lease is $675,902. So in the governmental funds, you're going to debit expenditures for that amount, and you're going to credit other financing sources, capital lease agreements. In the government-wide financial statements and the proprietary fund financial statements, in other words, under accrual, you're going to debit equipment for the leased capital asset, and you're going to credit capital lease obligation payable, which is a long-term liability, again, both of them in the amount of $675,902. In succeeding years, in the governmental funds, you're going to the $100,000 payments will be made, which is a credit to cash, and it's a debit to lease expenditures. And in the accrual-based financial statements, you're going to debit interest expense and capital lease obligation payable. They will total the $100,000 payment, but the balance will depend upon the rate that's being charged. So a part of this is interest expense, a part of it is reducing the outstanding liability, the long-term liability for the capital lease. Obviously, cash is credited for $100,000, and you're going to depreciate the capital asset, the leased capital asset that you have acquired as the lessee. An important feature of a lot of governmental leases are these things called fiscal funding and cancellation clauses. They exist because there are governments that aren't allowed to enter into obligations that extend beyond the current year, the current budget year. And so they have to have these clauses in these essentially long-term capital leases to say that they can cancel them at any time if they choose not to appropriate the necessary funds to make the required lease payments under that capital lease. Now, in reality, that hardly ever happens. And so the accounting standards require, in almost all cases, for the lease to be reported as a capital lease, for it to be capitalized, because the possibility of cancellation is remote. If the possibility of cancellation of this particular lease is more possible than remote, then you wouldn't be treating it as a capital asset. But as I said, in practice, those fiscal funding and cancellation clauses are almost never utilized, and they're in the lease agreements, but they're almost never acted upon by the government. And so in virtually all cases, even with the existence of this clause, a lease will be treated as a capital lease, presuming, of course, that it meets one or more of those 4 criteria. Now, one of the big problems, with lease accounting is that those criteria are so black and white that it leads to governments structuring their leases in a way to avoid meeting the criteria for capitalization. And now you may ask why they would do that, because it doesn't have a net impact on their balance sheet, right? They're going to recognize a capital asset and a long-term liability of equal amounts. But a lot of governments, have some real strong limitations on how much they're allowed to borrow or how much they're allowed to have as long-term liabilities. That's part of the reason for those fiscal funding clauses, and so they can't be shown to have a long-term liability in their view, and so they will structure a lease so that it is 74.9% of the economic life of the leased asset, or 89.9%. The payments, the present value of the payments are equal to 89.9% of the fair value of the asset. So that's a problem. Where they're essentially manipulating the terms of these agreements in order to avoid reporting what, in its economic substance, is really no different from any other capital lease. There's also been the creation of these off-balance sheet entities. In the case of governments, they're referred to as component units, legally separate entities for which a government is financially accountable, and they do this in order to move the long-term liabilities related to their leases off of the balance sheet. They'll create the separate entity and enter into a transaction in which the other entity now possesses the asset and is leasing it back to the government, but with terms that avoid it being reported as a capital lease, or that other entity is leasing the capital asset from some other entity instead of the government, the primary government being the lessee. So last year, in November of 2014, the board issued a document called a preliminary views, which is a due process document intended to obtain public feedback, but it's typically used earlier in the process at a point when the board has not settled on what it definitely believes should be the new standards, or when there's some division in the board, more than two or more of the members have an opposing view, or and this is, I think, becoming increasingly common for the GASB, for very complex projects, issues that have very wide-ranging financial implications, or that are likely to be controversial, or that will make very significant changes in the existing standards, to have this extra round of due process before putting out an exposure draft, which is essentially the final version of the standards, and really is more of a fatal flaw review. Having this extra opportunity makes sure that everybody has the opportunity to share their views with the board at a point where the standards aren't set in stone yet. The primary reason why the board issued this document and why it started to look at the existing standards in the first place is that they've been in place for a very long time without any significant review. FASB Statement 13 came out, I think, in 1975, and around there, 75, 76. NCGA Statement 5 came out in 1982. And so that's a pretty long period of time, over 3 decades, without having questioned whether they continue to be effective for governments or not. Plus, they were largely private sector standards that were really never adapted at all, with certain exceptions like the provisions for fiscal funding clauses and cancellation clauses. But otherwise, they were more or less brought in as is from private sector standards. In the period since those standards came out, GASB obviously has issued a lot of pronouncements of its own. It's issued 6 concept statements that, among other things, define what an asset and a liability are, which are pretty key concepts for determining what should be reported as a result of a lease. And it just so happens that for the last number of years, the FASB and the International Accounting Standards Board have had a joint project looking at the existing lease standards in their literature, and it made sense to monitor what they were doing, and then to have our own project, working from what they've done as a reference point, rather than doing our own thing and then they make changes and we really need then at that point ought to think about whether the changes they made are things that really ought to be made in our standards as well. We can really do it all at the same time, and as we generally like, is to avoid reinventing the wheel. We're always very happy to use another standard setter standards if they work for state and local governments and if they have what the board believes to be the right answer to a particular accounting question. It's much better to have that that commonality in our standards if one answer is an appropriate answer for both the private sector and the public sector. So what these proposed new standards are trying to do is to improve the usefulness of the information that reflects the impact of these transactions on a government's finances. So as a bond analyst or a taxpayer association or some other user of the financial statements, the information that results from the new standards should be considerably more valuable than what they received before. At the same time, the board is hoping that this proposal will reduce complexity for governments and for auditors, make it simpler to determine the appropriate treatment for the reporting of the leases, and in the process improve the comparability of the information that one government is reporting relative to the information that another government is reporting, which also enhances the usefulness of the information. If it's more comparable, that's better information for financial statement users. The proposal applies to any contract that meets the definition of a lease that is set forth in the proposed standards, and there's an emphasis that says focus on what the definition says and not on whether it's called the lease or not called the lease. That doesn't matter. If the substance of the transaction meets the definition of a lease, then it should be treated as a lease for accounting and financial reporting purposes. What is not included are contracts that transfer ownership, the leases with bargain purchase options, which are essentially just a financed purchase, and things that are already excluded from the lease standards, like mineral rights, lumber rights, water rights, licensing for films and manuscripts and patents and so on, and service concession arrangement transactions, which are covered by GASB Statement 60. So the proposal defines a lease as a contract that conveys the right to use a non-financial asset, that is the underlying asset, for a period of time in an exchange or exchange-like transaction. The inclusion of the word contract is meant to emphasize that this is a legally enforceable transaction. The use of non-financial asset offers the opportunity that we might be talking about a lease of an asset other than a capital asset, although we're still talking about non-financial assets here. So things like securities lending, and other types of investing transactions, those are not included here. And lastly, pointing out that this is an exchange or an exchange-like transaction is meant to emphasize that this is an exchange of equal value or relatively equal value, and we're not talking about a transaction where there are just sort of token payments involved. That's a non-exchange transaction, and there's a whole different set of standards that apply to those types of transactions. The lease term is really important to be able to establish, because you're basing the numbers that you're going to report related to these leases on the present value of the future payments. So you have to know how many periods are going to be involved when these payments that are required by the lease are going to be made. So you initially start with the period over which the lessee has a non-cancelable right to use the asset, and you're going to add periods that are covered by options. If the lessee has an option to extend the lease, if it's probable that the lessee is going to do it, then you should include those periods. Um, Periods that are covered by a lessee's option to terminate the lease should not be included if it's probable that the lessee is going to terminate. Any cancelable period is going to be left out, and the current practice of essentially ignoring fiscal funding and cancellation clauses because the possibility of cancellation is remote will continue. If it's not remote, if the possibility is greater than remote, then these are not going to be treated as capital leases. But as I said before, in virtually all cases, it's going to be treated just like any other lease. Fundamental to what the board has proposed in these new proposed standards is the idea that all leases are financings. They're essentially just like borrowing to purchase a capital asset. You don't get to keep the capital asset at the end, but what you were purchasing as a capital asset is the right to use somebody else's capital asset, and that itself is an intangible capital asset. And the way that you are financing the purchase of that right to use the capital asset is through the lease payments. Therefore, the board believes that all distinction between capital and operating leases should go out the window, that all leases should be treated as capital leases, that they're all financings. So that takes out all the complexity involved in determining whether something is an operating or a capital lease. It treats all leases exactly the same, and every lease that meets that definition of a lease that's proposed would be treated as a capital lease, and you get all the operating leases out of the way. There is a practicality exception that the board has proposed, which I'll talk about a little bit more later, that has to do with short-term leases, those that are 12 months or less at maximum, and I'll explain those in a little bit. So let's look at the accounting by the lessee first, and then we'll look at the accounting by the lessor. The lessee, when it enters into the lease, is going to recognize an intangible asset that represents its right to use the asset that belongs to the lessor, and it's also going to have a liability, a long-term lease payable that is related to the future lease payments that it's going to make. There is no change, and I'll just say this once and it will repeat on other slides, but there's no change to the way that these are dealt with in governmental funds because they're still not going to be reporting a capital asset or a long-term liability in the governmental funds. That initial measurement of the lease liability is going to include both fixed and variable payments over the course of the lease term. Certain of the residual value guarantees that are made, meaning they promise that there will be a certain value to that asset at the end of the lease term when the asset is returned to the lessor. As long as these payments are either certain or probable, they should be included as a part of the measurement of the lease. The discounting of the future lease payments to their present value should be based generally on whatever rate the lessor is charging the lessee in the lease, unless for some reason that rate is not readily determinable, in which case the lessee's incremental borrowing rate is going to be used as the discount rate. The initial measurement of the lease asset, so this intangible asset that the lessee receives, should include the value of the initial lease liability, so that the present value of those future payments, plus any prepayments that the lessee made, and any initial direct costs if they're ancillary charges to placing the leased asset into use. If there's a transportation cost to move the asset from wherever it is now to wherever to the government's location where the government's going to be using that asset, that's probably a direct cost that is ancillary to the placing of the leased asset in use, and that should be included in the measurement of the lease asset. In subsequent years, then, as the lessee makes lease payments to the lessor, it's going to reduce the size of the lease liability, by the portion that is essentially for principal, the total payment less the amount that's related to interest, and it's going to amortize that intangible asset, capital asset related to the right to use the underlying asset. The disclosures are largely similar to what is currently disclosed, but you're going to see a lot more disclosure of the leased assets because a lot of these leases might have been treated as operating leases in the past, for which there is very little, if any, disclosure. So you're capturing a lot, all of the leases now rather than just some of them, and you're going to get the same kind of information, describing the nature of these leases, what the terms are, what options there are for termination or extension of the leases. You're going to see the value of the leased assets disclosed by major class of leased asset. You will see the future minimum lease payments for each of the next 5 fiscal years, and then in 5-year increments after that until the full maturity of all of the lease contracts. If there are any lease commitments other than short-term leases that a government has entered into, but the lease term hasn't begun as of the date of the financial statements, those will be disclosed, and then a variety of other types of information as well. On the lessor side, this is a mirror image, essentially, of the transaction from the lessee side. The lessee has a lease payable, the lessor has a lease receivable. The lessor is going to continue to report the capital asset rather than de-recognize it as they would under the existing standards. And they're going to report a deferred inflow of resources that is related to the lease payments in future years, because those are related to future periods, so you're not going to recognize revenue for them right away. You will recognize a deferred inflow that will then make its way into recognition of lease revenue over the term of the lease. As I said, the underlying asset will continue to be reported by the lessor and depreciated just as they would under the existing standards, unless it is required to be returned in its original or better condition than when it was first leased, in which case the lessor will not depreciate during the period of the lease. These are essentially the same items that are recognized in the lease payable by the lessee. Those are the same things that are going to be recognized in the lease receivable of the lessor, as long as those payments are reasonably assured of being received. Again, you're going to be using the same discount rate to calculate, using the rate that the lessor charges to the lessee, and then in subsequent years, the lease receivable will be reduced by the portion of the payments that is not related or not attributable to interest. That'll be reported as interest revenue. The rest of it will reduce the amount of the outstanding lease receivable, and the deferred inflow of resources will be reduced in a systematic and rational manner, as and revenue then, as the revenue is being recognized. The lessor disclosures are very similar to what is reported now, including descriptions of the terms of the leases, and some details about the types of assets that are being leased, and essentially the same type of maturity analysis that the lessee is doing with minimum future lease payments. These are you know, minimum future lease payments to be received by the lessor for each of the next 5 years individually, and then in 5-year increments thereafter. I mentioned earlier that the exception to this requirement that everything be treated as a financing, essentially as a capital lease, uh, would apply to short-term leases, which the board has proposed would be defined as those with a maximum possible term of 12 months or less, including any options to extend, and the maximum it could possibly be would be 12 months. These will be, treated, as current period inflows and outflows rather than being reported as, as a, a capital asset and a long-term liability for the lessee, or a long-term receivable and a deferred inflow of resources for the lessor. And there are a couple of reasons for that. One is that the board thinks that the closer you get to the end of the contract, the less like a financing it looks. When you're a long distance away from the end of the contract, you have many years left to go, it clearly looks like a borrowing. But when you get inside that last year, um, financially, it doesn't look any different than if you had just leased that asset for that 1 year. Also, from a very practical standpoint, there's a cost associated with reporting leases as capital assets and long-term liabilities or long-term receivables. There's tracking and measurement that needs to be done, and there's a cost associated with that, both in terms of dollars and staff time. And the board believes that the value of treating these very short leases as financings, you know, doesn't match the cost that would be associated with doing it. That users of financial statements wouldn't necessarily get useful information if these very short leases were treated as financings. Certainly not in comparison with the value of that when they're looking at long-term leases. And so, because all standards have to balance costs and benefits, and they only establish, requirements when the benefits that result outweigh the costs associated with complying, the board's decision was that this was an exception that was necessary. There are a variety of other provisions in the preliminary views, and I'm not going to get into those in any detail. They're a little bit arcane. One thing I would mention very quickly is the way that the board has proposed dealing with subleases and leaseback transactions. Subleases, would be treated as an entirely separate transaction rather than the government perhaps netting its lease as the lessee with its sublease as the lessor. They're separate transactions. They should be accounted for entirely separately. And a sale leaseback transaction where the government is selling the capital asset to another entity, which often is a governmental entity, which then in turn leases it back to the government, those should be treated as entirely separate transactions as long as this really is a qualifying sale. It really is a sale of the asset, and the government no longer owns it, but is really leasing it now from this other entity. In leaseback transactions where the government leases the asset to another entity that then in turn leases it back to the government. Essentially, in these transactions, the two entities are both lessee and lessor over the same underlying asset. And so, unlike the subleases and sale leasebacks, where they should be treated as entirely separate transactions, in a leaseback, they should be netted against one another, and just the net effect of the transaction should be reported by both the lessee and the lessor. The comment period for the preliminary views was March 6th of 2015. The board is holding public hearings in 3 cities in April of 2015, and then it will begin to redeliberate based upon the feedback that it received in response to the preliminary views. and the expectation under the current schedule is that an exposure draft of proposed standards would be issued in January of 2016, probably with the typical 90-day comment period, and that if everything proceeds as expected, a final statement on leases would be issued in November of 2016. So we're still talking about several years down the road before governments would begin to implement these new standards. We're probably talking something like 2018 or 2019 fiscal years. But this is an ongoing project, and so you're getting a taste right now of the gestation period for accounting standards before they get set in stone and governments have to actually start complying with them. Thank you very much for your time, and as always, if you have any questions about anything that I've covered in this lecture or anything in the readings for this unit, please don't hesitate to email me or to post a question on the course website, and that way I can answer it and everybody will benefit from the answer to the question. Thank you.